Hey, good morning once again, and welcome back, options traders. Well, here's another good question for the group. Which is more profitable, stock or options? Well, if you ask most options traders, they're going to immediately jump and say, well, that's an easy question. It's obviously options. But if you remember from previous videos, I've always talked about how everything in finance is about a trade-off. So there must be some type of a trade-off here between the stock and the options when it comes to profitability. So what is that? What is this profitability trade-off between stock and options? You need to understand this to make good decisions. So let's go have a closer look, and before we do, as always, please be sure to click like and subscribe. It's greatly appreciated and helps to promote the channel. So let's start off with a comparison. Let's say that the stock is trading for 100, and in a pricing model, I've set it so that a 60-day at the money $100 call is trading for $5. And the question is, which is more profitable? Well, the answer is, part of the answer anyway, is that it depends on how you define profitable. Are you talking about total dollars or the percentage return? And so remember, if you're really trying to make money, the total dollars should be a far more important measure than the percentage. You can't go out and buy things with percentages. That just shows maybe an efficiency on the money that you're using, and it certainly counts. But this is really where the comparison comes down to. So let's take a look at a risk graph for long shares of stock. So here's our 100 shares of stock. At 100, we break even right there, where the black line crosses zero, and we make dollar for dollar up, and we lose dollar for dollar down. Now, if we compare this to the current curve for that 60-day option that we just saw in the previous slide, its risk graph would look like this. So take a look over here beyond 100. We can see that the risk graph for the long shares of stock sits above the call. In other words, for any stock price in this direction, as that stock price rises, the stock is going to make more money. Now, one of the trade-offs, one of the reasons we might lean towards buying the call, is over here to the left. And that is, if we're wrong, that we can see that the red line loses less because it sits above the black line. So again, this really emphasizes that call options are about risk management. They're not about maximizing the dollars to the upside. They are about minimizing the losses if you're wrong. Now, if we look at this risk graph at expiration, we would see it move from this red line to this. And now we can definitely see the stock is far more profitable. That black line sits far above the red line. And we can also see that in this example, it must be by $5. That's this break-even point. Remember, the stock breaks even right here at 100, but the $100 call that we purchased for 5 has a 105 break-even. And we can see that right there where that red line is crossing our zero line. Remember, zero means no profits and no losses, or in other words, break even. So we need that stock to run up to 105 at expiration just to break even. But the stock trader would be up $5. Now, if we look to the left, we can also see the insurance qualities coming into play, and the red line definitely sits far above the black line if we're wrong. Now, in this case, we can see that the stock and the option have the same loss of $5 at a stock price of 95. If the stock is 95, obviously the stock trader lost 5. And if it's 95 at expiration, then obviously the call trader lost 5. But if the stock falls below 95, now we can see that the stock trader continues taking losses, whereas the option trader caps out at that $5 maximum loss. Now we can look at this graph in a table form like this. These are again from a pricing model. These are various stock prices, and these are the call prices at these stock prices right here, according to a pricing model. So notice that if the stock goes from 100 with the call valued at 5, it rises to 101, the call is worth 555. That's a 54-cent gain. And most of you know that because the delta is roughly a half. We should pick up roughly 50% of that $1 move, or in this case, it was actually 54 cents. But the stock trader picked up a full dollar. If the stock rises from 101 to 102, The option rises from 555 to 612. That's an increase of 57 cents. Now we're starting to see gamma kick in here. It's not going to be a constant 54 cents. It's going to increase. So the call trader picked up 57 cents on that dollar move, but the stock trader picked up a full dollar. He went from making $1 to now making $2. So we can see at every step of the way, the stock trader outperforms the call trader in terms of dollars. But what about in terms of percentages? Well, if we go from a stock price of 100 to 101, that is a 1% increase. But look at the option. It increased 11%. The stock trader obviously increased 1% because he's holding the stock. His profitability in terms of percentages will always match that of the stock. So the stock trader made 1%, the option trader made 11%. If the stock rises from 104 to 105, that's about a 0.96% increase. But look at the option. It goes from 736 to 802. That's an 8.9% increase, almost a 9% increase, so about 9 times bigger than that of the stock trader. What if the stock rises from 110 to 111? That's about a 0.91% increase. But the option rises from 1170 to 1251, which is a 6.9% increase. So now, in rough terms, a little over sevenfold in terms of percentages. And this is why most options traders immediately jump on the idea that the option must be more profitable. But when you think about it, an options delta is usually only 1 if it gets very deep in the money or if we're in the money at expiration. So it's not 1 all the time, but the stock delta is always 1. See, every time the stock rises a buck, we can see these just rise by 1 every single step of the way. That's not true for the call. Only if we went way beyond this, maybe to stock prices of 125 or 130, would we see the option pick up a buck and the stock pick up a buck. But prior to that, the stock will outperform the option in terms of dollars. Now, there's another way we can talk about profitability. What if instead you buy 4 calls? Let's say if we buy 4 of those $100 calls, remember they're $5 each, so that would be $20. But now you're controlling 400 shares. You're not comparing equal deltas. And this is again where a lot of traders get tripped up and they'll say, well, I can either pay 100 for the stock or I can pay 20 for some options and I'm controlling 400 shares. And so I'm becoming far more profitable. Well, that's not really the proper way to look at it. You're controlling far more shares or deltas. So if you buy 4 of these $100 calls for $5 each, this is what your current risk graph looks like. See, now we're seeing the opposite. Now if the stock price rises, the red line sits well above the black line. Yes, the call option is far more profitable, not only in percentage terms, but in total dollars. But again, that's because you've got 400 deltas up here and only 100 down here. So you're not really comparing apples to apples. But at expiration, we know that that red line is going to move from its current position right here down to this risk graph. That's our familiar hockey stick graph that we usually look at. Again, we have 400 deltas up here compared to 100. But now we can also see that there are areas where we will lose more money with the call than with the stock. So the main thing to take from this is you have to be really careful when you are doing stock and option comparisons. 100 shares of stock are always more profitable than 1 call. And that's again because the stock delta always equals 1. The call delta is less than. Once in a while it can be equal to 1, but again that's right at expiration or unless that call goes super deep in the money. But for the most part that call delta is going to be less than 1. And again, a reason that many traders mistake this idea that options are more profitable is that traders often buy more calls for less money. But remember, when you do that, you are not comparing equal deltas. Now that doesn't mean that stock is better than options or options are better than stock. I just wanted to point this out to help you make decisions. If you buy 4 call options instead of 1 call option, understand you're dealing with 4 times the amount of leverage. It doesn't mean that the options are necessarily more profitable. It just means that you have chosen to be on a steeper and therefore riskier slope. And if you don't take those into account, that's where people end up getting hurt with their trades. So I hope that helps you to make better decisions and understand the trade-offs in terms of profitability when it comes to stock and options. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a candlesticks and technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.